All right, investors, let's talk about a silent, relentless predator that's consistently gnawing away at your hard-earned wealth. It's not market volatility, and it's not inflation, not directly anyway. It's taxes. Think about it. You make smart investment decisions, your portfolio grows, and then, without much fanfare, a significant chunk of your gains simply vanishes. This isn't just an annual inconvenience. Over decades, the compounding effect of taxes can diminish your potential returns by a staggering 20%, 30%, even 40% in some cases, effectively stealing your retirement dreams or pushing back major life goals. It's money you earned but never truly got to keep. This insidious erosion is precisely why we're tackling a critical conversation today. Now, why is 2026 specifically a focal point? Because savvy investors understand that effective financial planning is not just about reacting, it's about proactive future-proofing. The landscape of financial regulations and tax codes can shift, and by strategically positioning your portfolio now for 2026 and beyond, you're not just preparing for the immediate future, you're building a more resilient, tax-efficient foundation for decades to come. This isn't just a date on a calendar, it's a strategic waypoint for optimizing your long-term growth and ensuring your financial freedom isn't derailed by avoidable drains. Today, our spotlight shines brightly on taxable brokerage accounts. Unlike the protective cocoons of a 401k or a traditional IRA, which offer tax deferral or even tax-free growth, your standard investment account operates without those built-in shields. Every gain, every income stream is exposed. There's no sympathetic deferral here. The taxman is ready to collect his share, often year after year, as long as you're making money. And that, my friends, is the core problem. Imagine diligently planting seeds, tending to your garden, watching your plants flourish, only for a portion of your harvest to be automatically claimed by someone else simply because you grew it. In a taxable brokerage account, every single dollar you generate through the market, whether it's from a stock price appreciating, a capital gain, a company distributing profits to shareholders, a dividend, or even interest from a bond, is a potential taxable event. These aren't just abstract concepts, they're real-world financial leaks that can severely dampen your portfolio's true growth potential and delay you from reaching your monetary milestones. This constant drip, drip, drip of taxation is the difference between comfortably retiring at 60 and having to work another 5 years. To navigate these waters effectively, it's essential to grasp a few fundamental tax concepts. We'll be talking about capital gains, the profit you make when you sell an asset for more than you bought it for. Crucially, these are divided into short-term, assets held for less than a year, taxed at higher ordinary income rates, and long-term, held for over a year, taxed at potentially lower, more favorable rates. Then there are dividends, payouts from company profits, which can be qualified, taxed like long-term capital gains, or non-qualified, taxed as ordinary income. And finally, the infamous wash sale rule, a tricky regulation designed to prevent you from selling an investment at a loss, immediately buying it back, and claiming that loss for tax purposes. These aren't just abstract concepts, they're real-world financial leaks that can severely dampen your portfolio's true growth potential and delay you from reaching your monetary milestones. But here's the good news, the antidote to this tax erosion. You don't have to stand by idly. In this video, we're not just going to complain about taxes, we're going to empower you. We're about to unveil 7 of the absolute best exchange-traded funds, or ETFs, specifically designed with tax efficiency in mind, perfect for your taxable brokerage account in 2026 and beyond. More than just a list, this is your toolkit to sidestep those common, yet often invisible, tax traps that snare unsuspecting investors every single year. Consider this your personal invitation to step into a new era of proactive financial stewardship.
Understanding these specific strategies and how they apply to your taxable accounts isn't just about saving a few dollars here and there. It's about preserving thousands, even tens of thousands of dollars over your investing lifetime. It's about ensuring your hard-earned money stays where it belongs, working for you, building your legacy, and accelerating your journey toward true financial independence. Let's unlock that wealth together. If you are actually gaining value from this video, please kindly consider subscribing to this channel, as it costs you nothing to do, and like and share it to reach a broader audience looking for this video. And most importantly, tell us where you're watching from in the comments section.
All right, so we've established the why. Now for the how of navigating the tax landscape. Our first stop on this tax battlefield is capital gains. When you sell an investment for profit, the tax impact hinges on your holding period. Sell within a year, it's a short-term capital gain, taxed at your higher ordinary income rates, potentially up to 37%. Hold for over a year and it becomes a long-term capital gain, enjoying significantly lower preferential rates, typically 0%, 15%, or 20% based on your taxable income. For 2024, for example, a single filer below $47,025 pays 0%. Up to $518,900 pays 15%, and above that, 20%. These thresholds adjust, and while the core structure should hold for 2026, legislative shifts are always possible. Understanding this is foundational. Next, let's decipher dividend taxation, a critical distinction for your taxable accounts. Dividends fall into two camps, qualified and non-qualified. Qualified dividends are taxed at those same favorable long-term capital gains rates, 0%, 15%, or 20%, provided they meet specific criteria, like originating from U.S. or qualified foreign corporations and certain holding periods. Non-qualified dividends, conversely, are taxed at your much higher ordinary income rates. Prioritizing ETFs that primarily distribute qualified dividends can substantially improve your after-tax returns, making this an essential filter in our quest for tax-efficient investments. How do ETFs achieve superior tax efficiency over traditional mutual funds in taxable accounts? It's thanks to the authorized participant mechanism and in-kind redemptions. Mutual funds often sell holdings to meet redemptions, triggering capital gains distributions to all shareholders. ETFs avoid this. When large investors, authorized participants, redeem ETF shares, the fund hands them a basket of underlying securities, not cash. This in-kind redemption means the ETF rarely needs to sell appreciated assets internally. By sidestepping these internal sales, ETFs dramatically reduce the likelihood of distributing taxable capital gains to you, minimizing your annual tax burden. It's a structural advantage mutual funds simply cannot replicate. Understanding these tax intricacies brings us to asset location, not what you invest in, but where. This foundational strategy dictates placing tax-inefficient assets like high-turnover funds, certain high-yield bonds, or REITs into tax-advantaged accounts, 401k, IRA, where earnings grow tax-deferred or tax-free. Conversely, tax-efficient assets, such as broad market equity ETFs with low turnover and qualified dividends, are ideally suited for your taxable brokerage account. By strategically allocating assets, you minimize immediate tax drag, allowing more capital to compound untouched. So what makes an ETF truly tax-efficient for 2026? We seek several key characteristics. Firstly, low portfolio turnover. Funds that trade frequently generate more internal capital gains, which we want to minimize. Secondly, broad market exposure. These passively managed funds track major indices, inherently leading to lower turnover and diversified holdings. Thirdly, a strong preference for qualified dividends taxed at lower rates. Fourthly, minimal internal capital gains distributions to shareholders, thanks to the ETF structure. Finally, consider specific fund structures. Large-cap growth-focused ETFs often have lower dividend yields, advantageous if deferring income tax is a priority.
These criteria will be our compass. Let's apply these principles to unveil our first tax-efficient ETF recommendations for 2026, starting with a titan, the Vanguard S&P 500 ETF, VOO. VOO tracks the S&P 500, offering broad exposure to 500 large U.S. companies. Its incredibly low turnover, characteristic of passive indexing, translates to minimal internal capital gains. Dividends are overwhelmingly qualified, benefiting from preferential tax rates. With an ultra-low expense ratio, around 0.03%, VOO is a foundational taxable portfolio asset. iShares Core S&P 500 ETF, IVV, and SPDR SPDR S&P 500 ETF Trust, SPY, offer comparable tax advantages and exposure. For broader market coverage, consider the Vanguard Total Stock Market ETF, VTI. VTI encompasses the entire U.S. stock market, large, mid, and small-cap companies in one fund. Like VOO, it features extremely low turnover, predominantly qualified dividends, and a tiny 0.03% expense ratio. This comprehensive exposure maximizes tax efficiency while capturing overall market growth. iShares Core S&P Total U.S. Stock Market ETF, ITOT, and Schwab U.S. Broad Market ETF, SCHB, are equally strong alternatives. These funds perfectly embody our criteria: broad, diversified exposure with minimal tax drag, keeping more wealth compounding.
Okay, so we've established a solid foundation with domestic broad market ETFs that minimize tax drag, but true diversification and advanced tax optimization extend beyond our borders and into different asset classes. For 2026, let's broaden our horizons. If you are actually gaining value from this video, please kindly consider subscribing to this channel, as it costs you nothing to do, and like and share it to reach a broader audience looking for this video, and most importantly, tell us what you think about the values we have shared so far. Next up on our list, for robust international equity exposure that doesn't ignore tax efficiency, consider ETFs like Vanguard Total International Stock ETF, VXUS, or its iShares counterpart, iShares Core MSCI Total International Stock ETF, IXUS. Both offer vast global coverage, excluding the U.S., at low costs. Alternatively, if you prefer regional tilts, Vanguard FTSE Developed Markets ETF, VEA, and Vanguard FTSE Emerging Markets ETF, VWO, provide diversification. For the crucial fixed income component, especially for taxable accounts, tax-efficient bonds are paramount. Vanguard Tax-Exempt Bond ETF, VTEB, or iShares National Muni Bond ETF, MUB, are fantastic choices for municipal bonds, offering income exempt from federal and sometimes state and local taxes. Short-term Treasury ETFs also offer federal tax exemptions. Let's dive deeper into those international equity ETFs. A key advantage many globally diversified funds like VXUS or IXUS offer is the Foreign Tax Credit, FTC. This isn't just a fancy name, it's a direct dollar-for-dollar reduction of your U.S. tax liability for income taxes you've already paid to foreign governments on dividends from those international holdings. Funds that qualify often pass this credit through. You claim it on your tax return, usually Form 1116, reducing your overall tax bill. It's a powerful tool, ensuring you're not double taxed on foreign investment income, making international diversification even more appealing in a taxable account. Now, navigating bond ETFs in a taxable brokerage account is nuanced. Distinguish between taxable bonds and tax-exempt municipal bonds. Holding a total bond market ETF like BND in a taxable account incurs ordinary income tax on its fully taxable distributions.
For maximum efficiency, municipal bond ETFs such as VTEB or MUB are often the superior choice. Their income is typically free from federal income tax and sometimes state and local taxes too if you invest in bonds from your own state. Our advice? Use municipal bond ETFs for core fixed income in taxable accounts to shield income, reserving taxable bond ETFs primarily for tax-advantaged accounts like IRAs or 401ks for tax deferral. Beyond smart fund selection, mastering tax loss harvesting for 2026 is a game changer. This strategy involves selling investments at a loss to offset capital gains and potentially up to $3,000 of ordinary income annually. Here's how. Identify holdings whose value has dropped. Sell them. Crucially, avoid the wash sale rule. You cannot repurchase the substantively identical security within 30 days before or after the sale. Substantively identical means the same fund or one tracking the same index. For example, if you sell a Vanguard S&P 500 ETF at a loss, you couldn't buy an iShares S&P 500 ETF within that 61-day window. Instead, pivot to a total stock market ETF for that period, maintaining market exposure while adhering to the rules. Record keeping is vital. Track sale dates, purchase dates, and replacement assets. These harvested losses can be carried forward indefinitely, a powerful tool to reduce future taxes. What about dividends? Reinvesting dividends versus taking them as cash presents another tax-aware decision. While dividend reinvestment automatically compounds your growth, acquiring more shares with each distribution, you're still taxed on those dividends when received, even if you never see the cash. Taking dividends as cash gives you immediate liquidity. This cash can be used for rebalancing your portfolio without selling appreciated assets, potentially deferring capital gains, or it could fund living expenses. For those focused on long-term hands-off growth, reinvestment is often preferred, despite the immediate tax, as it simplifies compounding. For investors actively managing their asset allocation or needing regular income, taking cash offers greater flexibility and control over your capital. The best choice often depends on your personal financial situation and investing goals.
If you are actually gaining value from this video, please kindly consider subscribing to this channel, as it costs you nothing to do, and like and share it to reach a broader audience looking for this video. And most importantly, tell us that you have learned so far. Finally, integrating these ETFs into a holistic, tax-optimized portfolio is where true financial alchemy happens. For a growth-focused investor, a core of low-cost, broad-market domestic and international equity ETFs with a strategic allocation to municipal bond ETFs for stability could be ideal. Income-focused individuals might prioritize a larger allocation to municipal bonds, perhaps coupled with high-quality dividend growth ETFs in tax-advantaged accounts to avoid immediate tax on income. A balanced investor would find a mix of all these, carefully calibrated to their risk tolerance. Remember to consider rebalancing. Instead of selling appreciated assets and triggering capital gains, look for opportunities to add to underperforming assets or use new cash injections to maintain your desired asset allocation. This tax-aware rebalancing minimizes unnecessary tax events, keeping more of your hard-earned money working for you. All right, as we wrap up our deep dive into the best ETFs for your taxable brokerage account in 2026, let's bring it all together. We've explored a carefully curated selection of exchange-traded funds, each chosen for its inherent tax efficiency. From broad market index funds like Vanguard's VOO or Schwab's SCHB, providing diversified, low-cost exposure with minimal capital gain distributions, to international stalwarts like VXUS that often generate qualified dividends, or even sector-specific funds like VGT with their growth focus reducing income distributions. We also looked at bond ETFs like BND for stable income, emphasizing those with lower turnover.
The common thread among them? Their design inherently minimizes tax events, whether through passive indexing, low portfolio turnover, or a focus on qualified dividends, ensuring more of your investment returns stay in your pocket. This isn't just about picking popular funds, it's about strategic, tax-aware selection. Now, let's confront the 3 critical tax traps that can silently erode your wealth, and more importantly, how to meticulously avoid them. First up, the wash sale catastrophe. This isn't just a minor inconvenience, it's a rule designed to prevent you from claiming a tax loss if you repurchase a substantially identical security within 30 days before or after selling the original at a loss. Common mistakes include thinking a different ticker automatically makes it non-identical, often not true for highly correlated or mirror image ETFs from different providers. For example, SPY and VOO are often considered substantially identical by the IRS if used for the same market exposure. To avoid this, be acutely aware of the 30-day window. If you sell at a loss, wait at least 31 days before repurchasing any fund that tracks the same index or sector. Meticulous record-keeping is non-negotiable here. Utilize spreadsheet software or your brokerage's tax reporting tools religiously to track your buy and sell dates, ensuring no disallowed losses surprise you. Our second trap: unqualified dividends and high turnover fund shock. Not all dividends are created equal. Unqualified dividends are taxed at your ordinary income rate, potentially much higher than the preferential qualified dividend rate. Before investing, always check an ETF's prospectus, particularly the tax information or distributions section, to understand its tax qualification history and policy. Websites like ETF.com or Morningstar often list this data. Hand in hand with this is high fund turnover. While it may not directly impact your individual dividend taxation, high internal portfolio turnover within an ETF can generate significant short-term capital gains that are then distributed to you, creating a taxable event. Prioritize funds with low turnover ratios, typically below 20%, as this indicates a more buy-and-hold strategy within the fund itself, which translates to fewer distributed capital gains for you. Due diligence here isn't optional, it's fundamental.
The third major pitfall: surprise capital gain distributions. This often catches investors off guard, especially late in the year. Many ETFs and mutual funds distribute capital gains to shareholders, even if you haven't sold a single share. These distributions are taxable in the year received. To proactively check for these, visit the fund provider's website, Vanguard, iShares, Schwab, etc., in late November or early December. They usually publish estimated year-end distribution schedules. If you're planning to buy a fund that's about to make a large capital gain distribution, consider waiting until after the X distribution date to avoid getting taxed on gains you weren't truly part of. Conversely, if you have existing losses from other investments, strategic tax loss harvesting can help offset these unexpected gains, mitigating their impact. Looking ahead to 2026, the legislative landscape presents potential shifts we need to consider. The Tax Cuts and Jobs Act, or TCJA provisions, are set to expire, which could mean changes to individual income tax rates, standard deductions, and possibly even capital gains rates. While nothing is certain, being aware of these possibilities allows you to prepare your portfolio for potential tax environment uncertainties. Diversify, remain flexible, and understand that proactive tax planning is an ongoing process, not a one-time event. So what are your actionable next steps? First, take an hour to review your current taxable brokerage holdings, cross-referencing them against the tax-efficient principles we've discussed today. Consider a tax-aware rebalancing using new contributions or strategically selling underperforming assets to align with these strategies. Set up a robust record-keeping system for every trade, dividend, and distribution. And perhaps most importantly, don't hesitate to consult a qualified tax advisor or financial planner for personalized guidance. They can help navigate your specific situation, which might be more complex than general advice. Your financial future is too important to leave to chance.
take control by applying these principles. If you found this video insightful, please hit that like button, subscribe for more tax-smart investing tips, and share it with anyone building wealth. Engage with us in the comments. We love hearing from you. Remember, building long-term wealth isn't just about what you earn, it's about what you keep through smart, diligent tax planning. Your future self will thank you.